Welcome to the Lockbox, where we try to share valuable real estate insights that you might not be able to quickly Google search. Today we're going to talk to you about an ongoing thing that's happening in the world, the U.S. trade wars, or the impending U.S. trade wars, I should say. And so I brought a special guest, Richard De Chevigny from BRX Mortgages. Richard's here to help us because you might be wondering, what do trade wars have to do with real estate? Well, they kind of have a lot to do with real estate, mortgage fluctuations, rising lumber costs, different things like that. So he's also been taking a look at it, and let's have a conversation with Richard and find out what his thoughts are, shall we? Richard, how are you today?
I'm good. Thank you for having me, Donnette.
Thanks.
I think that I'm going to start this off by just prefacing that I'm not an expert in this area, but I do follow it closely because it's part of my job. And a lot of things are going to be coming from these tariffs. I guess most notably, when there's 25% tariffs put on Canadian lumber, steel, and aluminum, the cost of building materials are going to increase, which will then get passed down to the consumer. I think we've also seen that when the new housing costs increase, people will shift their purchasing from new housing to resales.
Right. Those prices might increase too then, right? Supply and demand, of course, basic economics.
Of course. And I think you've probably already seen that there are a lot of multiple offers on listings nowadays.
Yeah, it's actually crazy. It's kind of like COVID, right? Like just the way it's been going for the last 2 months. It's really impressive.
Yep.
Lots and lots of bidding wars and very low inventory.
Yep. And I usually see a lot of these bidding wars happen at the lower price points, but there's been a shift over the last month and a half, 2 months, or even those houses that are $500,000, $600,000, $700,000 are also having bidding wars.
Are they?
Yeah.
Interesting.
Yeah.
What percentage over do you think that they're going?
Do you know what? I always just look at dollar values, and
okay.
I've been seeing a lot of houses going $60,000, $70,000, $80,000 over the list price. To me, that's a lot.
That is a lot.
And from a financial standpoint, I always have to think about how long is it going to take for the client to recoup that money back? Are they paying too much for the home? And if they are, it's always the question of the client, like how long is it going to take for us to actually get that equity back? Because quite often, if you're buying a house that's $400,000 and it's selling for $500,000, well, it could take 5 years for you to get that equity back.
Even a little bit more.
Or longer.
So that means basically you can't sell the home, or you can, but you might be selling at a loss if you had to sell
Absolutely.
Before the 5-year time or anything like that. So It's just something for people to be aware of.
And that's the premium you pay for winning the offer, right? Because there's so much competition.
Right.
I've seen clients write 5, 6, 7 offers and just get beat every single time.
Yeah.
And I've said in other videos, it's very demoralizing for clients to go through that. So they usually step up their game and decide that they're going to offer more because the urgency for them to actually get into the home is increasing, because maybe there's timelines where they have to relocate or their leases are up and they have no other options.
Yeah, absolutely. That is very true. And I mean, we have been through that before, and it is quite tough. It is tough for everybody involved, the agents as well as the clients, right? So, okay, so you're thinking that with the trade war, or impending trade war, I should keep saying, because of course we're not in it yet.
Not yet.
It's not something, or you feel that that's going to impact the housing prices in that capacity, so prices naturally will rise.
Mm-hmm.
Now, please, note here that this is all speculation. We have no crystal ball. We are not able to see the future. This is just based on things that we're reading, things that we're learning, just like everybody else, right? It's a fast, fluid market. But
Yep. I think it's important to note that people who are shopping for a house, a lot of them are on the fence because the house prices are going up, right? There's these bidding wars.
Yeah.
So they're scared. They're scared to buy. And what's actually happening is, because they're not buying, quite often these people are going to be move-up buyers.
Right.
So they're not selling. So it's also creating additional competition because there's less houses on the market, which I know you're seeing.
Absolutely.
That there's not much on the market because people are on the fence, right?
Yeah.
And another thing that I've been seeing is people all of a sudden not qualifying, right? Because a couple of reasons. First of all, I've been seeing debt payments going up. So people are spending more money on their credit cards and not paying that off.
Okay.
So those are slowly climbing because of inflation,
Okay.
which is also a result of trade wars and trade wars that could happen.
Yeah.
Plus the political landscape, in Canada and the U.S.
Right.
is causing all kinds of inflationary issues. So debts are going up. People are qualifying for less. People are bidding on houses over the amount that they qualify for.
Okay.
So now deals are falling through.
Okay.
Because they're getting their offer accepted because they're bidding higher.
Yeah.
But then all of a sudden, when it goes to the lender, they find out, well, they don't qualify. So now it's back on the market, and someone else has to buy it.
Okay. So you're saying here that that's a lot. You packed in a lot of information there that I think is really good for consumers. So because people aren't now they're not qualifying because interest rates have gone up, interest rates have gone down. Can we talk about that a little bit for the viewers?
Well, I think when we're talking about interest rates, when we say rates are coming down, because everyone's talking about the rates are coming down, right?
Yeah.
And they are coming down. But typically when people will come to me and say oh, listen, I heard rates are coming down. I want to get pre-approved now. When rates are coming down, it is typically because the Bank of Canada has reduced the overnight lending rate. And I don't even like to talk about the overnight lending rate because that doesn't really affect the mortgage clients. What affects mortgage clients is prime rate. So when prime rate comes down, it just decreases the overall rate that people are going to pay on their mortgage. Now, in Canada, there's also fixed rate mortgages. They will jump in the market assuming that fixed rates are now 3% when that's the overnight rate. That's the rate that the banks will use to lend each other money overnight. It's not the prime rate that mortgages are based off of. Now, when mortgage rates come down, more people are obviously going to go and shop.
Right.
It's funny because people don't realize this, but when you're talking about the economy and these trade wars, people think that that rates are going to be skyrocketing all the time. Well, bad news in the economy typically means that rates are going to drop because the Bank of Canada needs to stimulate the economy by making the money cheaper. So when good things are happening in the economy, rates go up, and when bad things are happening in the economy, rates are going to go down.
So really, in theory, what you're saying is, though tariffs are a negative, it's going to impact the economy negatively. So our interest rates may or may not go down. They should, but we can't promise that.
They should, but a lot of other things will affect interest rates. So trade wars and tariffs are just one aspect of it. There's inflation numbers. So it just ticked up to 1.9%. So that was indicative of a lot of economists saying that for the next Bank of Canada meeting on March 21st, that they are probably going to hold the rate steady. They're not going to decrease it anymore for the next meeting. But there's a lot of other data points that need to come out for them to know what to do. There's employment numbers, right?
Right.
That's also very important.
Right.
And again, that's only going to affect the Bank of Canada's rate decision. It's not going to affect fixed rates. Fixed rates are another beast. And typically what will happen is, in the life of a mortgage broker, is every morning we wake up, we look at the 5-year bond index, and we find out where that is. And if it's been increased for 3, 4, 5 days, you'll actually see that lenders will start sending rate increases. So rates are going to go up. And when they come down, for example, when the 25% tariffs were announced, well, then the rates went down. And then when they said that they were going to pause, rates went up. So as rates go up and down over a period of time, that will actually flow through the market. And then that's when lenders will increase or decrease rates. So in a rising rate environment, when I'm working with a client, if we think that rates are going to rise in the long term, we work on getting them pre-approved and get a rate hold, just so that they're protected in case rates continue to go up. And then if rates stay low or go lower, they always get the lower rate. In this market, though, it's very unlikely that rates are going to go up substantially over the long term. So most clients aren't getting rate holds at this time.
Okay. So they're doing variables then, or what would you say?
I would say it depends on the client. Variable products or adjustable products versus fixed products are really dependent on the type of client that I'm working with. Someone who's more risk adverse and doesn't like to take chances, usually like fixed rates. I always show all my clients, the difference between the fixed and the variable, what we think might happen with the variable over time, and then based on the information that I give them, let them choose what they think is best. But a lot of my clients are in variable, not just because historically it's cheaper, but because it also has lower penalties if they were to leave their mortgage or switch their mortgage. And it also offers them the flexibility that if they think that variable rates or prime rate is going to continue to go up or stay the same or not go down as fast as they would like, they can usually convert it to a fixed rate with no penalties. And they can't do that with a fixed rate.
They can't flip back to a variable if they wanted. No. So you can go one way, but you can't go the other.
Correct.
Okay. So all very valuable information, almost something we should do a second podcast on one of these days, right? Because we veered a little bit, but it's all encompassing. It all matters,
yep.
Right? So any other thoughts toward the trades and what the impact on us? Like, my personal opinion is that we are a very insulated and diverse market here in Manitoba, specifically Winnipeg, right? If you're thinking about other provinces, they will probably be impacted a little bit more because they're heavy in aluminum or heavy in oil or something like that. Whereas that is not the state of our economy here. So though we will have a blip, I believe, I don't know that I think that it's going to be deeply impacted, just as it was with COVID or other major things that are happening within the market, right? As an overall, but that is my one person's opinion. But what are your thoughts?
I think you're right. I think we are insulated in Manitoba. We're insulated from a lot of these tariff issues, but everyone's feeling inflation, right? Everyone's feeling inflation. Everyone's feeling inflation. Everyone can feel the cost of living rising.
Absolutely.
And I, from the conversations that I'm having with clients, there are a lot of people who are struggling still.
It's unfortunate, isn't it?
Yep.
Yeah,
it is. So I think it's more important than ever that people who are, whether you're in the market to buy a home, in the next 3 to 6 months or even next year, it's really important to have a professional look at your entire financial situation, because a lot of people, they're going to go into their bank or another lender for a mortgage, and they're going to walk out with just a mortgage. They're going to walk out with the approval or pre-approval for the largest debt of their life without actually looking at all the factors that are encompassed in their financial situation. And then they're just left on their own, right? Rather than if you're working with a mortgage planner, someone who's looking at everything, you can look for ways to optimize their debts and safeguard them in the future. Because one of the things that I've really moved away from since becoming a mortgage planner is everyone always offers the advice on set your payments up as accelerated biweekly payments. And this is a conversation that we've had before.
We did have this not long ago. I loved it. Tell everybody.
Yeah, and I think that is good advice for a lot of people. But if you're working with a client and you see that they don't have savings or 3 to 6 months of living expenses saved up and put aside in an easy to access way, then you really need to start thinking ahead and using your first year or so in your home to, instead of making accelerated biweekly payments, you take those accelerated biweekly payments, the difference between that and a regular payment, and put it aside in an account, an easy to access account, just in case emergencies happen. Because usually what will happen is you buy your house or something happens financially and you dip into your credit card right away. And all of a sudden, when you have any significant amount of debt that's in a 19.9% credit card, it just starts compounding so fast that you have a hard time paying it off. And then eventually, this beautiful time of buying a house, it turns into a really bad experience, because now you're staying up late at night, you owe all this money, things are getting tighter and tighter.
Yeah.
And you never had a plan put in place ahead of time. And quite often, all that you need to do to safeguard a client from that is doing the extra steps ahead of time, taking the extra time to to find out what their entire situation is, and then putting a plan in place so that they can create that safety net. And then once you have that safety net, then divert those funds in a way that potentially can give them tax refunds, because that's a big strategy of mine, or put it down on their mortgage, and if that's the most important thing, work on paying that off as fast as possible.
You were talking about accelerated payments. So for the people who are listening who don't necessarily know what that is, did you want to just break that down?
Most mortgages in Canada are actually on biweekly payments. So every 2 weeks you would make your mortgage payment. Accelerated payments are taking 13 months worth of payments and dividing that by 26 individual payments. Essentially, you're having an extra month of payments that go directly towards the principal, which will pay off your mortgage faster, right? It's kind of like a set it and forget it approach. I actually think of it as a lazy approach because there's a lot more things that you can do with it. And it never really came to light, like as a mortgage planner, and I'm very big using my proprietary software to calculate the benefits of things.
Right.
And it wasn't until COVID hit that I realized that there were a lot of people who prior I would have said, accelerated biweekly payments is the way to go. It's safe. You're going to pay off your mortgage faster. But there was a huge influx of people who all of a sudden were facing, terminations or layoffs at their work. Mm-hmm. And when that happened, they didn't have the funds, and they also couldn't qualify to get the money out of their mortgage, right? Because now they're not working, so now they don't qualify to get the money out that they've been putting in. So what happened to all that money? Well, it's locked into their home, right? Some of those people had to sell their home. A lot of them were able to weather the storm by getting into more debt, using lines of credit and credit card. But it dawned on me at that point that there was a better way to do it. There was a way of, instead of doing those accelerated payments, just take the difference and put it into that special account.
So you're talking about an account, not necessarily something that's locked in like an RSP or a GIC. You're more talking about like just a secondary savings account.
Yeah, I would say it's RSPs are not really I'm not a financial advisor, but I would say RSPs aren't typically the best thing to do in the first step. Okay. If you don't have that 3 to 6 month living expenses set aside, the first thing you can do is put it in a TFSA.
Okay.
Right? TFSA, because it's not taxed to take it out. It's really easy to access.
Yeah.
While you're still getting that growth.
Right.
Do I recommend keeping it in a checking or savings account? No, I don't, because it's not going to grow at all there.
Not even the high yield savings accounts that they offer?
Well, unless they're offering you more than inflation, you're losing money every day.
See, right? Okay, there you go. Good thing.
So I would recommend, at the very least, putting to a TFSA. When you can sum up how much bills you have to pay in 3 to 6 months, and you have that much saved, then you can start thinking about, what do we do next? What's the next step?
Okay.
And you always have to look, like right now, at year 1, we're buying this house, or year 0, we're buying this house. We want to retire in year 25.
Yeah.
Well, how do we bridge the gap from where we are now to where we want to be in 25 years? And then quite often, it's the mortgage strategy that can get you there, because half your wealth is tied up in your debt.
So I noticed that you're calling yourself a financial, what did you call yourself? A mortgage planner, not a financial planner. You called yourself a mortgage planner. Now, I've always heard bank, like a mortgage specialist. I've heard mortgage broker, but never mortgage planner. So can you tell me a little bit about what the difference is, or is that kind of what you're talking about right now?
I think a lot of people will call themselves, it's interchangeable.
Okay.
I use that term strategically because I think there's a big difference, right? There's a mortgage person at the bank. Now that would be your regular
like the big fives.
Yeah, but any of the big banks or credit union, right?
Oh, okay, yeah.
Those would be people that not only provide mortgages, but typically they're trained to sell products like credit cards and life insurance and investments.
Yeah.
The people at the banks, they're not licensed to sell mortgages. They don't have to be. Okay. And then you have the step up. You have the mortgage specialists. Those people would work for the banks or credit unions, but typically they're the banks, and all they do is mortgages. So they're very, very familiar with mortgages as it relates to that specific bank.
And they are licensed?
No, they are not licensed. They don't have to be licensed because, again, they are regulated by the Bank Act and they are hired by the bank. So if you were going to the bank and be like, hey, you over there with the mop, do you want to do mortgages today? They could do that if they want. And people don't realize that the people at the bank, a lot of the people who aren't the mortgage specialists, they probably process very little mortgages every year. So they don't really, most of them probably can't even tell you how to calculate your mortgage penalty.
Okay.
Now, then you have a mortgage broker or a mortgage broker. They typically don't work for a bank or a credit union. They work for themselves. They're self-employed, and they work with a multitude of lenders. So they have to be up to date in the policies and procedures of many different lenders and credit unions. They all have to be licensed, and they are typically more skilled at providing mortgages.
Okay.
And then you have mortgage planners. And some people will call themselves a mortgage planner just because they tell a client to have accelerated biweekly payments.
Okay.
But that is not really a mortgage planner in my definition. My definition is someone who actually creates strategic plans using the mortgage. So not just looking at the mortgage and giving someone a 25-year debt, but looking at the entire picture and figuring out how they can use the mortgage to increase their financial benefits. With my clients, a lot of it is going to be, how to obtain tax refunds and how to, extrapolate how these tax refunds and how these mortgage costs are going to position you in different time horizons. So, not just what it's going to cost you and what you're going to earn in the term,
okay,
but how does that align to your goals? If you have any retirement goals, or if you have any big expenses that are going to come up, well, how do we plan for that in the future, like right now, so that you're prepared in the future, so that if something does happen, you're covered.
Is there anything that you want to say before we close this off?
Yeah, I would say no matter what situation you're in, the most important thing that you should do is work with a professional mortgage planner, someone who's going to ask you the question, what are you comfortable paying? Someone who is going to figure out, where are you now? Where do you want to be in the future? And then show you multiple options, physically show you side by side multiple options so that you know exactly where you stand and what's the best choice for you.
Okay, that's really good. Thank you everyone for joining us. I really hope that you found this episode to be insightful and informative. I would hope that if you enjoyed this, I want you to hit subscribe because you're always going to see content like this. Take a look at our show notes below if you have any questions or want to go back to something. You can also find both of the links for myself, Donnette Odidison, and for Richard De Chevigny of BRX Mortgages. We'll have all of our links down below for you to look at and be able to contact us. So thank you so much, Richard, for joining us today. I think that this was a phenomenal conversation. Far more than just tariffs, which, again,
We
just
knew that was going to happen.
we did know that was going to happen. But again, I think that the takeaway on tariffs is we both believe that we are an insulated, diverse market here in Winnipeg. And so we might see a blip, or we probably will see a blip, but it shouldn't impact us too harshly. That is the takeaway on that. There are always going to be tariffs. It's more about the economy and everything else and inflation, and that's kind of why we veered in these different conversations. So I really hope that this was great information for you, and take care, and we'll see you on the next episode.